The home office deduction is one of the most powerful tax breaks available to self-employing people, and most of them never claim it. The reason most freelancers skip it is an old myth, that claiming it triggers an audit. That myth is out of date. Since 2013, when the IRS introduced the Simplified method, millions of self-employed filers claim this deduction safely every year. The IRS expects you to take it. The question is how. To qualify, a portion of your home must be used regularly and exclusively for business. Regularly means ongoing, not occasional. Exclusively means that space is never used for personal activities. The kitchen table where you eat dinner does not qualify. A corner of the living room that is only ever your desk does qualify, even without a door. It can be a room, a defined area, or a separate structure. The simplified method is exactly what it sounds like. Multiply your office square footage by $5, up to 300 square feet, for a maximum deduction of $1,500. A 200 square foot office gives you a $1,000 deduction. No receipts, no depreciation math, no portion of rent calculation. Clean, fast, and a reasonable starting point for a first-time filer. The actual expense method takes more work, but typically produces 2 to 5 times the deduction. Calculate what percentage of your home the office occupies. Then multiply that percentage against your total housing costs, rent or mortgage interest, utilities, insurance, repairs, and depreciation if you own. A 200 square foot office in a 1,600 square foot apartment is 12.5%. At $33,000 in annual housing costs, that is over $4,000 back. Compare that to $1,500 on Simplified. Simplified wins when your office is small and your rent is modest, or when you just want clean and easy. Actual wins when your office is 150 square feet or more, and your housing costs are real. For most freelancers in a moderately expensive city, actual expenses are worth the extra math. You can switch between methods year to year. Pick whichever produces the bigger number for your situation. The most common mistake is claiming a shared space as exclusive use. A dining table you also eat at is not a home office, no matter how many hours you work there. The second mistake is not measuring. Write the number down. The third mistake is skipping the deduction entirely. That is the one that costs the most. Claim it, document it, and keep those records for at least 3 years after filing. ABLE does not file your taxes. What it does is make sure the money for taxes is already set aside when April arrives. Every deposit you log runs through the Floor First system. Tax comes off the top before anything else gets allocated. No scrambling at quarterlies, no surprise bill in April. The money is already there because every deposit put it there. From unable to able. Try it free for 30 days at becomeable.app.